National. Go like a pro.
Chris is waiting on the line in Vancouver. Hi there, Chris.
Hi. Can you tell me what you think about using moving averages to get in and out of the market in total cyclically? I'm thinking of an example like the 6-month exponential moving average, and maybe not to actually sell all your positions, but at least short an index to get rid of beta.
So just to quick explanation, obviously moving average is a smoothing mechanism where you take, say, the previous 50 days and you average the prices, and it gives you a sense for what the trend in the security has been. You can have a 50-day moving average, a 150-day moving average, 200-day moving average. When we look at stocks, and this is not something that we spend a lot of time doing, but I think it is useful. If I were looking at a new security and I'm satisfied that fundamentally I'm comfortable with the position and it's a leading security, I like the sector, I like to see price characteristics that support my view. I don't want to be the only one out there interested in the security. So one of the things I'd like to see is I'd like to see that the 50-day moving average is sloping upwards, which means it's in an upward price trend. I'd like to see the 200-day moving average, which is a long-term price trend, sloping higher. There's a bunch of things then we're going to do with that. Once we own a security, we'd like it to see it stay above the 50-day moving average. It's often going to dip a little bit below, but certainly the 200-day moving average is a good indicator of long-term trend. If you're looking at it in the market, it's similar. You want to watch the moving averages, and you can use them for stop losses. It's maybe not the most effective way to do it, but I think that the two things you want to look for is the price of my security, the market, above the long-term moving averages, and then second, is the moving average sloped higher. The last thing I think you can do is look at a basket of securities and say what percentage of them are above the 50-day moving average, and this would be more relevant to us. I like to see the percent of stocks trading above the 50-day moving average increasing. That tells me we're in a healthy market. More and more securities are doing well. When we start to see the number of stocks above the moving average deteriorating, it tells me that the breadth in the market is weakening, and you want to be careful. And that's where you may use that to decide to hedge a portfolio when you start seeing deterioration. So just recently, 80% of stocks in the NYSE were trading above the 150-day moving average. In 17 times where that's happened in the last 40 years, in 16 cases, when it went below 60%, it meant the market was going to a point where fewer than 30% were above the 150-day moving average before the correction was done. So right now, about 50% of stocks. So we think that there is some room to go to the downside here. And so we are actually hedged in our equity portfolios.
And would you add as well, another factor, David, is that you're not the only one looking at the moving averages, and it becomes sort of self-fulfilling in a way if other traders are doing the same thing?
That's the problem with single stock or an index, is that the 50-day moving average is something everybody looks at. So I don't think it's a terribly effective way, because you'll see hedge funds push a security down below the 50-day moving average to try and bring in sellers. But when you're using it to calculate some breadth calculations for a basket of securities, I find that very useful.
All right, David, let's talk to Tony now. He's in Montreal. Go ahead, sir.
Thank you for taking my call.
Sure.
I own NR Plus on TSX ERS. In the last 3 months, it has lost about 30% of its value. I still own it because of the good dividend they pay, but I'm worried quite a bit now, because does it have a chance to get back in the $20, or should I sell now?
Right.
Or are they financially sound to last until next winter when liquid gas is still in demand?
Right. So Tony, this is a common problem that people fall into. They hold a security and say, I'm going to hold it because the dividend is good. As an investor, you're looking at what is my total return. That's the combination of capital growth or capital loss and the dividend. This is a security that has been underperforming the energy space since 2007. It has consistently been working its way lower. I think this is not a leader in the group. I think it's a sector that has a problem. And if your concern is capital preservation, I think it should be. I think there are better places for you to be than in this security. If you're looking for a yield, look at a crescent point, and it's probably not even that right now. I think I would wait, as I said earlier, till later in the summer to be looking at energy. But I think you got to be careful, because I do think that there's downside in some of these securities.
So for this one, bite the bullet, take the capital loss?
I would do that. I don't like to buy in hope. And so if something isn't working, I think you really need to draw a line in the sand and not hope to get the share price back to what you paid, because the market doesn't know or care what you paid.
Right. Let's take a short pause here with David Burrows. More of your calls and emails on the other side. A reminder, though, that you can sign up for the nightly newsletter if you haven't done it already. You just have to go to bnn.ca/subscribe. You get analysis and top picks from our roster of guests.